This segment sponsored by Foster Financial. Today is Wealth Wednesday, and it is a special day because we get sound financial advice from Caleb Doane, who is the Vice President of Foster Financial. Hi, Caleb.
Hi.
How are you?
I'm doing well. How are you?
Doing well, thank you. Okay, so today we are talking about investment strategy and really how people can evaluate the best way to go about deciding if they're conservative or a little bit more growth oriented, right? So share a little bit about that.
Yeah, absolutely. I think this is something I've probably been asked, 15 times over the past year with just new clients coming in, because I think a lot of people thought, hey, I'm getting closer to retirement. I thought that my investments were relatively conservative, but in 2022, with the year that we had, their accounts might have gone down 10 or 15%.
Wow.
And so it's taken a lot of people, given them this opportunity to maybe reevaluate how risky or how, conservative their investment should be. And it's certainly a good time to take a look at that.
Okay, well, let's dive in. So first, what is the difference between the two? You have conservative and growth oriented or risky.
Yeah, okay. Yeah, exactly. So it's kind of a spectrum of investment options, right? And on the more conservative side, typically you have investments that give you more of like a stated interest rate. So that's things like bonds and CDs and fixed annuities. And the idea is, hey, this CD is supposed to pay me 4%, every single year. And of course, when you have lower risk like that, there's kind of that lower return. You typically get that 4%.
Right.
But, ideally when the stock market goes down, this doesn't go down as much. And then on the other end of the side, typically you have, equities or stocks. So, hey, I'm a shareholder in Apple. And so I bought a share of Apple for $100, and a year later, hopefully it's $110 or something like that. And so the thing is, everyone typically has a mix of those two types of investments in their portfolio. And the main question is, hey, should I be invested a 60-40 mix one way or a 60-40 mix the other way? How should I actually be invested? And I think that's something that really needs to be custom to every client.
Right, and that is so true about diversifying your portfolio, having things that kind of flow on the conservative side. Therefore, you have that safety net, but then you can have a little bit more fun, right? And I like the term growth oriented because those accounts really do have potential to really grow in fun ways. So if someone comes in and they're like, Caleb, which one should I do? How do you advise them? Yeah,
so I think a lot of people have maybe a little bit of a misconception in that your age is the one factor that determines how growth oriented or how conservative your investment should be. And people typically think, hey, if I'm really close to retirement, I'm 65 years old, I need to be on the more conservative side. And that's certainly something to take into account is your age, but there's a variety of other factors to account for as well. Namely, how much you're going to rely on your investments in retirement, your other streams of income, whether it's Social Security or a pension. And so just making that decision based on your age is probably a mistake that we typically help people avoid.
Right.
And I'd say one of the examples I typically use is that you could be almost identical to your neighbor in sort of a financial perspective. So, let's say you're both the exact same age, you have the exact same amount saved for retirement, you have the exact same, monthly budget that you typically use, you need $5,000 a month or whatever it might be. But let's say you have a pension that pays $1,000 a month and your neighbor doesn't. You two should be invested very differently in terms of how growth oriented or how conservative you should be. And so it's something that should be custom to everyone.
Yeah, okay. So with that custom process, how do you determine that? So a new client comes in and they're like, okay, Caleb, I don't know which way, I think I may be more conservative, but maybe they're not. How do you assess that?
Yeah. So we actually have every client take a risk quiz that we have. And this risk quiz asks, probably 15 or so different questions. And some of them are more kind of fact-based, like, hey, what is your net worth? And then some of them are, more opinion-based, like, hey, if the market were to go down, this amount, how would you react? Would you want to sell immediately? Would you want to double down your investment? And so we kind of use this whole, arrangement of factors to actually determine after this quiz, we think that you should be invested 55% in equities. And then we can present that to the client and let them know the rationale.
So tell me, has it ever been really crazy, like someone came in like, oh, I'm a risky investor, and then they take this quiz and they are not?
Yeah, no, that's certainly the case oftentimes. Or sometimes people will come in and they'll say, hey, I think my 401k is very conservative. And then, I'll take a look at it and say, hey, you're actually 90% in equities, kind of the growth-oriented side. And they say, oh, wow, I didn't realize that. And so it's certainly important to align and have a cohesive strategy around the investments and make sure it aligns with how risky somebody should actually be.
Yeah, okay, that's great. Well, thank you so much, Caleb, for breaking that down. We appreciate it.
Thank you.
Yes, and as you heard, Foster Financial can help you determine your appropriate risk so that you can be set for financial success. It's best to contact them for your complimentary consultation. We'll have their website listed below, and we'll be right back. This segment sponsored by Foster Financial.